Understanding the mortgage system, fraud, contracts, and financial manipulation. The historical shift to negotiable debt instruments. In 1933, during what is commonly referred to as the Great Depression, the federal government removed the United States from the gold standard, thereby initiating a strategic economic transformation. This shift enabled the U.S. to replace gold-backed currency with negotiable debt instruments, effectively transforming commerce into a system based on the exchange of debt. The government, in collaboration with private financial powers, leveraged a national crisis to erode individual ownership and establish long-term financial control over the populace. President Franklin D. Roosevelt issued an executive order compelling Americans to surrender their gold holdings. This gold was secretly funneled to the Vatican through intermediaries, particularly China. Today, the gold stored in Fort Knox is allegedly not owned by the United States but by the Vatican. Without a tangible gold standard, Americans began trading in paper currency that represented debt rather than value. The mortgage process: how borrowers fund their own loans. Modern mortgage agreements perpetuate systemic fraud. When a person takes out a mortgage, they sign a promissory note, which pledges their labor and credit. This note is then sold by the mortgage company to a secondary institution such as Fannie Mae or Freddie Mac. These warehousing institutions use the promissory notes as collateral to issue new loans to other entities. While these entities gain value from your credit, the original borrower receives none of the proceeds from these secondary loans. The irony is stark: individuals repay mortgage companies with interest, despite having funded the transaction themselves. Corporations, which are legal fictions without intrinsic value, rely on the credit of living individuals to function. The profits generated from selling your promissory note are tangible in a debt-based economy, even though they are backed by illusion rather than real assets. Dual accounting and fraud in mortgage servicing. Mortgage companies often maintain two separate accounting books. The local records suggest a loan was issued, while the second, often kept by an affiliated bank, records the borrower's payments as deposits. After the mortgage is paid off, the bank waits 90 days before petitioning the IRS to declare the funds as abandoned property, allowing the bank to legally retain them. This practice supports the wealth accumulation of elite banking families such as the Rockefellers and Rothschild, who profit off public ignorance and systemic manipulation. Legal infrastructure supporting financial manipulation. The shift from equity law to admiralty/maritime law under Title 28 of the U.S. Code redefined courtroom procedures. Today, courts presume guilt and place the burden of proof on the accused. This system mirrors military tribunals rather than civilian courts and undermines the constitutional principle of presumed innocence. Citizens are coerced into compliance through threats to their comfort and security. Government agencies, law enforcement, and judicial systems enforce statutes and codes designed to benefit elite financial interests while suppressing individual autonomy. The education system, media, and even religious institutions have been co-opted to propagate obedience and suppress dissent. 12 key facts about mortgage and credit fraud. 1. The Federal Reserve is a private banking entity controlled by foreign interests. 2. The United States owes its national debt to the Federal Reserve. 3. The 12 Federal Reserve member banks act as depositories and fiscal agents. 4. Federal Reserve regulations prohibit member banks from lending real assets. 5. Customers create money by signing promissory notes, banks contribute no funds. 6. Only banks can process promissory notes due to monopoly on negotiable instruments. 7. Mortgage contracts are invalidated by non-disclosure, violating federal lending laws. 8. Third-party debt collectors cannot enforce debts without explicit consent. 9. Banks must refund borrowers the full value of their notes minus fees and interest. 10. These practices apply to both secured and unsecured debts. 11. There is no legal requirement to disclose a social security number under most conditions. 12. The credit reporting system is a government surveillance tool designed to punish dissent. The Banker's Manifest, Control Through Foreclosure. A confidential 1934 excerpt from the Banker's Manifest outlines the strategic plan to dominate populations through debt enforcement and foreclosure. It states, debts must be collected and loans and mortgages foreclosed as soon as possible. When through a process of law the common people lose their homes, they will be more tractable and more easily governed by the strong arm of the law. This admission exposes the systematic effort to reduce individuals to controllable economic units, using debt as both a chain and the lock. Conclusion: recognizing and resisting the illusion. Understanding the true nature of mortgage fraud and the monetary system is a vital step toward reclaiming personal sovereignty. By exposing how promissory notes and social contracts are manipulated, individuals can begin to challenge the legitimacy of unlawful debts and reassert their financial independence. The challenge lies not only in education but in courage, the courage to see through the illusion and stand against it.